Now, when it comes to putting your money into crypto, just like most other financial assets, there are two very different ways of approaching it, which is pretty much investing or trading. But what is the difference? I hear you say. Well, both involve the buying of cryptocurrencies, but what you do with that cryptocurrency is completely different depending on whether you're looking at investing or if you're looking at trading your crypto. So in this video, I'm going to lay out the benefits and the drawbacks of each of those and give you some tips to help you decide which might be right for you. So make sure right now you are locked in and you keep on watching to find out. Hey, it is me, John Doe from Currency.com. Now, before we get into investing versus trading, I want to ask you for something. Hit that like button. Also, subscribe to the channel and hit that notification bell if you haven't already, so you know exactly when we're posting much more videos like this. All right, so first, let's have a look at investing. In simple terms, investing is all about the long-term value of an asset. And the goal is to gradually build up profits over the medium to the long term through buying and then basically just holding your asset. Now, compared to trading, investing is a far less intensive strategy with less time needed to track the movement of an asset on a regular basis. Now, I don't want you to get excited. That doesn't mean that investing is easy though. And trust me, smart investors put in the hard graft as they search for potential future growth of an asset, and doing your research and reading is super vital. And as well, you got to add in some fundamental analysis. And if you want to step up your game even more, check out our video that we have on fundamental analysis right here. Now, a key aim to investing is to try to ride out any short-term market volatility. Now, for crypto, that's something that happens pretty often. So investors often look to keep their money in the pot for years and maybe even decades. Let me give you one example. So let's say you had invested in 1,000 Bitcoin back in July of 2010. It would have been costing you about $90. And that's not a big sum of money to risk. So if you still had that investment today, let's just say right now, turn this video off. You wouldn't be watching this video right now because you'd be sitting on millions, having done nothing except keeping your crypto in your wallet safe and secure, and as well as watching the ups and downs of the price of Bitcoin. Now, that is an extreme example, but the key point in that example is that profits were made over the long term rather than hours or a day or even a month. And another way to limit being exposed to market volatility when investing is doing something called dollar cost averaging. It means investing small amounts regularly over a long period rather than one large lump sum, meaning that your investment is more secure against sudden spikes in price. Now, it is important to say though that just because investing is a long-term and lower risk, it doesn't guarantee you profits or protect you against having losses. A good investor will always look to diversify their portfolio, putting their eggs in multiple baskets to lower volatility even further. This way, if one asset flops, the others can still keep you in a profit. And I think for sure we will be doing a video on the importance of diversifying your portfolio. So make sure you are subscribed, like I mentioned earlier, and be on the lookout for that. It's also worth saying that investing can often access additional long-term financial rewards from assets such as interest and dividends. And for crypto, you get staking, where you get to stake your cryptocurrencies for a reward. And if you want to find out more about staking, then check out our video that we also done on that. We got it all, people. Anyway, let's get back to investing again. So who does it appeal to? Well, if you don't have the time or prefer to play it safe, then investing might just be the place for you. And if you're new to this and lack the know-how for what are called short-term trades, which is buying and selling assets on a regular, pretty much often on a daily basis, then it's also probably wiser to start with investing while you learn the basics of trading. And now, I think it is time we get a little bit more advanced and let's talk about trading. Now, let me pull up one of my quotes here. Okay, so with trading, you make money by acting. With investing, you make money by waiting. Rather than focusing on long-term growth as you do with investing, trading is all about making money from short-term price movements. The idea is to buy and then sell an asset over a much short time period. Weeks, days, hours, sometimes even seconds. Yes, you heard that right. And here's another important difference between investing and trading. While investing is focused on profiting from an asset going up, trading, you can actually profit from falling asset prices as well as rising ones. So while an investor will likely do nothing during a downturn in an asset's price and wait for the upturn to finally come, a trader is likely to be actively looking to make profit. And because trading involves looking to exploit short-term price movements, it is a lot more time intensive than investing. It is also higher risk because the assets are usually more volatile and the time scale of trades is greatly increased. Many traders spend hours every day studying the markets, so it is not something that a complete newbie beginner trader would usually dive straight into. And generally, there's about 4 styles of trading. Position trading is the longest term and involves spotting dominant price trends. Traders take a position on an asset price moving in one direction for an extended period of time. These positions can be taken for months and sometimes even years. Next, we have swing trading, which is probably my personal favorite, and that looks for large price movements over a shorter period of time, and it can be from weeks to maybe days. And then we have the highest risk and the one everybody wants to do, and that is day trading. And as the name suggests, that involves buying and then selling an asset all within a day. Finally, we also have scalping, and that's where positions are held for just a few minutes or sometimes even less. And the aim is to capture small profits with every trade, slowly scale that up to make multiple trades every day. Now, the style of trading a trader goes with, that's dependent on a number of factors, including how much time that can be dedicated to it, your level of experience, and also your risk tolerance. Now, what can make you a smart trader? Well, a key element is hard work and research. Pretty basic, yes. In trading, the fundamentals of an asset are less important than investing. So as long as the price goes up or down, the profit follows after that. And traders will usually rely on short-term technical analysis using price charts. And guess what? Yes, I got you covered on that as well right in this video right here. They often also use complex trading tools such as short trading or leverage trading. In simple terms, shorting essentially means you're speculating on the price of an asset to go down and making a profit based on the size of that drop. And leverage trading is the use of borrowed money to increase the size of the stake beyond what is available for you, and you can use much more trading capital. And that might sound a little bit too complicated, but do not worry. We got so much films to cover both short selling and leverage trading. So if you want to check those out as well, so much videos covering everything about crypto and trading, make sure you are following the channel. Now, what type of assets are favored by traders? It might sound so simple, but more volatile sectors such as Forex. Forex is popular when it comes to trading because of the potential for price movement. And then we have one of the most volatile assets you can invest in, unsurprisingly, trading crypto, which has exploded over the last few years. Now, that's a little bit of the ins and outs of trading, but what sort of person does it suit? Well, the reality is that trading takes up more time and effort than investing. It is a lot more stressful. So if you think you have the nerves and you got the time, then getting into trading might be right for you. But keep in mind, the risk higher, the money moves much faster, and you're far more exposed to market volatility. Now, as you can see, investing and trading are two very different ways of profiting from price movements of assets. And for most people, investing is the preferred way than trading because of the lower risk and less time and effort. However, there's no rule saying that you can't do both at the same time. You can build a nice investment portfolio and treat it as your personal retirement fund, but you can also play those short-term price moves of the markets, but just make sure that you do keep them separate. It can completely blow up your account if you bet your investment portfolio on short-term trades. And that's the fastest way to go from hero to zero. Now, whatever you decide, make sure to do your own research. Maybe try even a demo account with your preferred broker to figure out what is best for you. And as always, I'm taking off, but if you like this video, please like, comment, subscribe, hit that notification bell. Don't miss out on any more of our videos. It is John Doe here with Currency.com. Thank you for watching, and I'm gonna see you next time.